Welcome to the program. Today we'll talk about MyEFO, the Federal Reserve, what's going on in this disappointing stock market. We'll talk about some of the stocks that have performed this year, and we'll touch on our outlook for 2016. I'm Marty Switzer.
I'm Paul Rickard.
And we're mad about money. We've only got 2 minutes and we're going to go through each topic in no more than 2 minutes. Paul, first question. Scott Morrison's delivered his MyEFO, his first one for the year, a bit of a blowout in the budget. Your thoughts on what's happened so far?
Yes, Slow-Mo Scott, I think, was the headline this morning.
Scott.
I think that he gave the analogy of a car, and it's a long journey, and of course that's what it's proving to be in terms of getting the budget deficit back into a reasonable level. Look, I think a couple of takes. I think for investors the most important take was the government actually lowered its growth forecast.
2.5%?
Yeah, to 2.5%, but also for the outlying years back to 3%. I think that's more to be expected, but I think the take for us, if we look back what's happened the last 3 or 4 years and what's happening in the rest of the world, it's a slow grind, this economy. It's okay, but outrageous growth is not going to happen, and that also has an impact on the types of stocks we think about investing in. I think that's really important. Look, as for MyEFO, the mid-year economic and financial outlook, who invented that acronym?
Yeah,
who cares?
Yawn.
Yawn. Why do they do it on the 15th of December when everyone's asleep? Look,
probably because no one's watching.
Yeah, I think it's all a bit of a yawn. I mean, look, the right-wing press is out there this morning saying they should be doing more to cut the deficit and all this sort of stuff. To be honest, they can't. Their hands are tied by the Senate. I think it's great they're trying to take politics off the front page. I think ultimately that's better for investors. Look, and it's all the Australian people.
And the big issue at the moment that's hurting them is commodity prices. So for every dollar iron ore falls, that's about $250 million that comes out in terms of tax receipts.
Yeah, I think absolutely. There's nothing they can do about that. I think the only thing you can criticise the government about is about spending. And I think for every new spending program, that's where we should be sort of getting stuck into them about. But look,
maybe the Treasury forecasting is a bit bullish in terms of what they put in there for iron ore prices. Like, it's obviously such a volatile commodity. To have so much of your budget dependent on that, you'd think they should really be pricing that amount in a lot lower.
Yeah, I mean, I think they've come down to $39. Look, I think this...
That's 48, weren't they?
They were at 48. Yeah. I mean, I thought at the time they were pretty conservative. So they've gone further than I expected.
It has dropped, I guess, 80%, yeah.
Look, and it is a pretty hard thing, but of course it impacts company tax, and how can you tell how much profit BHP or Rio is going to make? So, look, I have some sympathy for them, but I think we're out of that. I think growth is going to be lower. I think that's the important take. I think it's good the government is actually trying to just be sensible and trying to get politics off the front page. So I think that's actually net positive for investors.
I know, moving on, we won't talk about Chris Bowen. Next topic.
They haven't been super boring, mate.
Next topic, the Federal Reserve meets, they're about to start their meeting now. We're going to get the decision as to whether or not they're going to increase interest rates from their historic lows. We've had a very tough market so far this year. A lot of people are hanging on for the Fed to, I guess, put some life into this market and hopefully stimulate a Santa Claus rally. Your thoughts, Paul?
Yeah, I think we'll find out. I think it's 5:30 a.m. Tomorrow, roughly. So when
16th isn't American time.
Yeah, so tomorrow morning the Fed will announce their decision after their 2-day meeting. Look, I think they're going to raise, which is the most important thing. It's all about the language they use, and
which Yellen hasn't been good at so far. She's sort of muffed. She's duffed a few of her statements.
Absolutely mucked it up in September, and it's what the language used in the press release and the subsequent press conference about what their approach to a second increase is going to be, what data they're going to look at,
and how fast.
That's what it's all about. Look, markets have sort of been on sort of tenterhooks and ahead of it. I think it's probably going to be a net positive. I think the dollar's already moved, the US dollar's already moved, so we'll see whether it's a question of buy the rumour, sell the fact. Coming back to the Australian market, it's just been a horrible couple of weeks. I think it's all about commodity prices, and I think people have underestimated just what that does for our major companies. Look, obviously the shorters are winning in this market. So we're at a 2-year low yesterday, Marty. I don't think.
So iron ore I sort of get, obviously because that directly affects two of the biggest stocks that make up the top 20. The energy sector obviously has a decent weighting of the ASX, but then there are all these other sectors in there that should benefit from the lower oil price. We don't seem to be seeing that yet. When do you think we could start seeing that? Because consumer discretionary should go well. A lot of the industrials are doing well because of the lower oil price.
And the lower dollar. So look, we haven't seen that. I mean, look, I think there's a lack of confidence, and I don't know whether it's a function of offshore just ignoring our market. Offshore looks as a bit like a commodity mine. Why would you invest in Australia when commodity prices are under pressure, and maybe that means downside for the Aussie dollar? So I guess offshore is ignoring our market, and that's probably the most important factor. And that sort of goes to our domestic institutions who don't have the balls to say this is good value. Look, I don't know why banks have been under pressure. I think we're probably going to see a better second half of December than the first half. I know it sounds like a broken record, but it's been a tough couple of weeks. I think the Fed getting out of the way, maybe we can get back into a bit more
based on the economic data, things are looking pretty good. GDP, employment, if that can feed through to earnings in next year, then maybe there's more positivity there.
The governor's statement yesterday. I mean, look, there's lots of positives out there. It's just not in our market. So, look, maybe today's the start of the turn of that, and we'll get a bit of a flow through next week.
Yeah. Moving on, next topic, stocks that have surprised this year. There's been a few stocks that have outperformed this year is probably a better way to describe it. In terms of the top 20, Paul, who are your two standouts?
It's interesting. I mean, the top 20, of the 5 names, 4 are what I'd describe as dollar-related stocks. So the number 1 performer this year is Macquarie Bank, up about 40%.
It's a great year.
Yes, CSL's about number 3, and then 4 and 5 are also the companies that are all beneficiaries of a weaker dollar, names like QBE. So they're at the top 5. The bottom 5 are all the commodity exposed stocks: Rio, BHP, Origin, Woodside. No surprises there. So I think the extent of when you do a quick recap on 2015. I never thought commodity prices had stopped their route. In other words, I didn't think they'd bottom, but they've come a lot further lower than I expected. Yeah. So we saw a big downward movement in 2014, don't forget. So oil is sort of, this year's down from 60 to 40, iron ore's from over 50 down to 39. So that's continued. The Aussie dollar seems to have found a bottom. So I think that's the tale of the top 20.
Qantas has had a good year?
Yeah, Qantas is up over 40%. I mean, so that's obviously one of the real stars.
So that's benefited from the lower oil price?
It's benefited from the lower oil price.
Their cost of goods is oil is about 35 to 40% of that. So that price goes straight to the bottom line, doesn't it?
Yep. I mean, the other ones, obviously some of the industrials have done better. I mean, people have been paying some really crazy prices for companies that can show growth. So we've had things like in the healthcare space, things like Blackmores and anything involved in
over 600, almost 600% in the last 12 months. Blackmores,
anything involved in vitamins or something. China,
yeah.
Dairy in China.
Yeah.
Domino's has done really well. Again, they've come out again with this morning with another announcement about another acquisition, also an upgraded guidance. So that's been a real
Bellamy's has been an absolute standout.
Yeah.
Tasmanian business.
Yeah. So look, there've been some successes, but overall, the top 20 have lagged, and where the growth in the market has been is in the so-called some of the mid-cap 50 stocks.
We take the mining out and we take the banks out, though. The rest of the sectors have done well, haven't they?
Yeah, look, they haven't done too bad. I mean, obviously, healthcare is overall really positive. Property trusts, utilities are all positive. Industrials are positive.
Consumer discretionary was about 10%. Yeah.
Yep. Just at the really big ones, financials are negative.
Yeah.
Materials are negative, and so is energy. And you've got the consumer staples, Woolworths and Wesfarmers are also.
So that would have hurt the index huggers.
That's hurt the index huggers. If you've been long the index, 2015 has proved to be a tough year. We're so far, with 2-year low yesterday, our worst December so far on record, but I think the second half of December stands to look a little more encouraging.
So 2016, we're developing an outlook statement on the Switzer Super Report with some of our key contributors. That's going to be delivered to our subscribers. If you want to get this outlook statement, it comes out on the 28th of December. You should take a trial to the Switzer Super Report. Paul Rickard is one of the key contributors. Paul, what are some of the things you're going to be touching on in terms of this outlook statement?
Yeah, I still think the 2 big questions are commodity prices and the impact on the Aussie dollar. If you think commodity prices are bottoming, then you've got to get into the energy stocks and the BHPs and the Rios. But look, I think it's too early to make that call. So I think for yield-based investors, you stay out. I think for growth-based investors, you've got to have a little bit of a dabble in there because you can't predict these bottoms, but that's hard. The second question is the Aussie dollar. I mean, it's found amazing support here at 70 cents. I can't understand it. They say the Aussie dollar goes up with the stairs and down with the elevator, because of what it is. We haven't seen a blowout bottom yet occur in the Aussie dollar. Maybe you're still going to be positioned in the dollar-based stocks, so the CSLs, the Ramsays, the Macquaries, the Brambles, those stocks that'll benefit still from a weaker Australian dollar. That's sort of the 2 big themes for me. The other thing is interest rates. Look, despite what's happening in the US, interest rates in Australia are on hold. I think there's going to be value in the financial stocks again because they've had their capital raisings. So that's where I'm sort of looking to enter 2016. I think a slightly more positive year than 2015.
Good to hear. You want to hear more about how Paul's investing, what Peter Switzer's looking at, how Charlie Aiken's investing, make sure you subscribe to that Outlook statement at the switzersuperreport.com.au. That's all we've got time for today. This is our last Mad About Money for 2015. Thanks for your support. It's been a great ride so far. We look forward to coming back and talking to you in 2016. Have a great festive season. I'm Marty Switzer.
I'm Paul Rickard.
And we're mad about money.